You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Molen and Charles Steinmetz.
Hey folks, welcome to Questioning Your Sense. I am joined with a new guest today, Zac Majors from Centric Advisors. As always, I'm your host, Kevin Molen. So we're going to do something a little bit different today. First, to start, Zac, welcome. Thanks for joining us.
Oh, I'm happy to be here.
Good. So we'll put you through the ringer a little bit today. I'm certainly going to try and get your opinion on a few things.
All right.
Zac, why don't you tell us a little bit about what you do and about Centric Advisors?
Yeah, sure, no problem. As Kevin said, Zac Majors, I'm the CEO and the founder of Centric Advisors. We have a couple different divisions that really support multiple types of people. So through our Centric Wealth division, we work with retail clients, so helping them make good, smart investment decisions, good financial decisions, which is completely different than investment decisions. We have a corporate retirement planning division where we help business owners set up and establish corporate retirement plans such as 401k plans or corporate pension plans. And then we have a what we call our partner division where we support different types of advisors, tax advisors like yourself, and other financial professionals and insurance advisors around the country.
Great. And how long have you worked in the financial world?
This is the only thing I've done out of college. So in college, I studied finance, and financial advising was something that I wanted to get into. Mm-hmm. It sounded cool. It sounded sexy, maybe more sexy than accounting and tax.
A little bit.
So I decided that financial advising was the route that I wanted to go. So right out of college, got into this business. So I've been doing it for about 12 years now. And about 5.5, 6 years ago, myself and my partner, who I met at a previous firm, we got fed up with where we're at, just different things, and the environment that we were in, and the way that they practiced, and the way that they viewed how to treat a client really ran counterintuitive to how we wanted to operate. And so eventually we started our own firm. It was named after myself and my partner at the time. And about, I guess, a year and a half, 2 years ago now, we decided to change our name to Centric to more represent what we're really about, which is being client-centered.
Mm-hmm. Okay, great. So the way we usually start this, and I'll give you a little bit of a break, but the way we usually start this is with some type of segue, something personal or professional going on in Charlie or my life. And so usually I have Charlie start, but this time around I'll go ahead and start, and then you can share if you'd like. So I will tell you, before COVID, starting in October of 2019, I started going to the gym for the very first time. I had never done it before, and nobody really tells you how satisfying it is to do. And for 3 months, I was going to the gym until January. Of course, tax time, right, hits, and February. I went one time before kind of a tax season day, which I'm working like 16 hours a day during that time. I went one time that morning and realized, no, this isn't doable. I can't do the gym and work 16 hours. And so I reluctantly threw the gym out of my plans. And then COVID happened, right? So then March, the gym essentially shuts down, and I put on my COVID-15 like most people, right? Maybe a couple more. After losing like 30 pounds going to the gym for 3 months, I really, really enjoyed it, but have been missing it ever since. And so they just recently, 2-3 weeks ago, I think, removed the kind of the mask and glove policy. They have reopened the gym, but I'm not going to the gym wearing masks and gloves, you know. Right. And so they just recently removed that. And so this morning was the first time I went to the gym since last year. So I feel great. I think I'm going to feel it tomorrow. But anyways, so that's me personally. Well, anything you want to tell me about?
Well, good. Well, so you lost 30 and gained back 15. You're still in a good position.
Just a little bit.
That's good. So I guess something personal. So something personal and maybe something not so personal. So myself, and I have 2 children, an 8-year-old boy named Nathan and a 6-year-old girl named Juliet. My wife and the 2 kids, we went to Disney last week. We went to Legoland and then Disney. So it was a week full of adventure for us. And the adventure started in the airport. So stood in line for 2 hours trying to get a rental car when we got to Florida. So I'm looking around thinking, are we in a pandemic or are we not in a pandemic? I thought that I was going to breeze through lines. And so the lines started there, and then the lines were long at Legoland and the other theme parks. everybody was out and about, everybody was spending money. So you start to see, and the restrictions were still in place, and at least at Disney, maybe not so much Florida, because Florida has eased up, but Disney has been very strict. And you had, Mickey Mouse coming up to you, telling you to put your mask back on over your nose. So it was interesting. But, I learned a lot of things on that trip. I learned that my son is very bold, more bold than I had really imagined. He's always had a mentality that's been very bold, and it's good because as an entrepreneur, you have to be bold. You have to take risks in order to get ahead in life. Well, I think he has the making of being an entrepreneur because of how bold he is. So I'll give you an example. There's a swimming pool at the resort at Disney. Just so happens that there's a cheerleading convention that is going on.
Oh, wow. And you said he's 8?
At Disney. He's 8 years old. And so my wife and I are in the hot tub area, and my kids are really proficient swimmers. So don't think that I'm a bad parent by letting them be in the swimming area. There were lifeguards and everything else there, but
of course,
they're really good at swimming. They compete on swim team and won lots of medals, etc., for doing that. But they were swimming, and my wife and I were in the hot tub, and this group of cheerleaders comes and joins us in the hot tub, and they started talking. And so my ears perk up, and they said, did you talk to that kid with the dog tags? And instantly I knew at that time that was Nathan, because Nathan he's all into the military. So he had dog tags on. And so I was like, okay, there's probably not any other kids with dog tags on. That's probably him. And they're like, and he said he's from Texas. I'm like, oh yeah, that's him for sure.
Yeah.
And so they were talking to each other. So my wife and I, our ears perked up. We're trying to eavesdrop on this conversation. Yeah. It turns out, so Nathan swam up to him, and according to the way the story goes, according to the girls, is that Nathan came up to him and said, "You ladies are smoking hot." And my wife and I looked at each other, and at that point we knew, yeah, that's Nathan.
Yeah.
If there was any doubt with the dog tags in Texas, we now knew it was for sure Nathan. So that was fun. We learned that he was bold, and God bless him. That's going to carry him far in life. Going to get him into trouble as a kid and as a teenager in the future.
Is this a like father, like son? Was that the pickup line for your wife?
something along those lines.
Oh goodness. Oh, that's fantastic. Well, thanks for the picture, because my wife and I and our kids are going to Disney ideally in December. We'll see what it's panning out. But okay, so to business, just want to get your thoughts initially. I'll kind of throw you a softball. I'm sure you get this question all the time. To clarify, you are a practicing financial advisor, right?
Yeah, that's right. Practicing financial advisor. I'm a certified financial planner as well.
Mm-hmm. Yep. As well as being an entrepreneur and a founder and owner and CEO. So the softball question is, how do you feel about the market right now?
That's a really good question. That's something that we get all the time.
Right. Yep, that's what I figured.
And this is one of the things that I prepared a few notes on before we came in here, just so I didn't put my foot in my mouth. But overall, the market in general, myself and our analysts at the firm, we feel very confident. April was a fantastic month for all the different asset classes: stocks, bonds, real estate, commodities, etc. All of it was really good. And I think that the theme's pretty loud and clear, and maybe echoed by what I learned at Disney with all the lines and the people out there, is that people have this bottleneck of money that they haven't spent yet. There's a lot of free money that's floating around out there. It's burning a hole in people's pocket. So they're out there renting cars, they're going to theme parks, they're buying shoes and all different types of stuff. So it's the great reopening. Every economic statistic over the past few months have been positive. There's 85,000 new homes that were purchased in the month of March. And that was the largest single month since August of 2006. First quarter GDP is up over 6.4%. That's the highest quarterly reading that we've had in 18 years. Fed's going to announce that they're going to be looking at keeping rates near zero for the foreseeable future.
How long is that going to last?
We'll see. But for businesses and stocks in particular, this earnings season, right? So how did we do from an earnings season? And almost all the earnings were up. Matter of fact, according to some of the experts, 87% of the companies that reported thus far have exceeded expectations. And they didn't just exceed expectations by a penny or by 2 pennies. They crushed expectations. On average, they 22.8%. And it's the highest that since our analysts have been tracking this back to 1994. It's the highest that expectations have been exceeded.
Wow.
So things are going really good. So there's a lot of positivity. Consumer sentiment is very high. Overall, very optimistic. There's one little caveat to all those things, and that's the valuations. Valuations of stocks are a little bit stretched right now. Fortunately, earnings are going to allow us to meet what those valuations are. But companies like Amazon and Tesla that have these very far stretched valuations is making the market in general, along with some other things, but making the market, the stocks in general, overvalued. So over time, I think we'll see earnings growth outpace stock market growth, which should bring that back into alignment.
Okay.
That's the technical answer.
There you go. That's pretty technical. I like data. I like statistics. So from a layman's perspective, my 401k is as aggressive as it can possibly be. It's a managed option, and it's as aggressive as it can possibly be. It has been since day one. Not that I'm the world's most aggressive investor, but I am a numbers guy, right? And the numbers tell me that all I have to do is just aggressively invest as young as possible. And even no matter how many times I lose money, that's going to come back. You think I should continue to invest aggressively?
Well, I mean, there's a lot of different schools of thought on that, but the short answer is I would say yes, right? You're young, you have plenty of time on your side, even if markets get frothy and go down.
I'm not trying to time the market here.
Yeah, I think that's what losers do, to be quite frank, right? The more you're trying to time, the more opportunities there are to lose. And there's a point in time where after you lose so many times, you stop getting back into the market, which is even worse.
Yep.
So yeah, invest aggressively and invest more when the market goes down. You do those two things, you'll be in really good shape.
Yeah. Okay, great. Okay, so one thing that I'm super passionate about, well, let me give some context to where I'm coming from first. So I work in a very older industry, right? So I am 35 years old. Not a ton of 35-year-olds pumping out tax returns right now. There's a lot of young blood coming into the industry, right? That being said, most solo practitioners and small tax firms are run by an older generation.
Sure.
And so I find that younger people are looking for apps. They're looking for online, something that is convenient for them, simply because what are they going to do? Go see their parents, accountant or tax advisor who's 70 years old in many cases, and they really can't relate to them at all.
Yeah.
One of my favorite things is working with a younger generation, simply because I was born in 1985. If I see somebody that was born in the 80s or the 90s, I know instantly that I'm going to teach them things that no one else has taught them before.
Yeah.
One of the things that I find is the biggest issue with people born in the 80s, people born in the 90s, even these kids born in early 2000, they're not contributing enough to their 401k. They get a raise, and that raise immediately goes towards a quality of life increase.
Sure.
And they're not being taught that they should be putting money in pre-tax or even post-tax accounts, depending on their tax bracket. So first, what I want to talk to you about is just what are your biggest tips when you're working with your younger clients, early game investing, right? 20s, early 30s.
Well, I think it's all about setting the foundation. We live in this society that values spending and values consumption and consuming as much stuff as we can. So it's not a surprise that your 20 and 30-year-olds are out there buying new shoes, right? The statistics around all the stimulus money that we've got, it went to high-end fashion in Jordans.
I hear you saying shoes a lot. Are you a
I'm not a shoe nut, but I just find it funny that's what we are spending all of our money on when we're in this pandemic, right? We're trying to survive. We're trying to make it, right? Please send us some more money from the helicopters so I can buy a new pair of J's.
Yeah.
I mean, it just doesn't make sense. I can get off on a tangent about that, but it all starts with the foundation, right? And it starts in the home, really. I mean, we can get into people's values and values of American society, but the long and the short of it is parents don't talk to their kids about money.
Yeah.
And when parents don't talk to their kids about money or expose them to what's going on in their own financial situation, they grow up ignorant of that because they're not going to get it through the education system. and they don't know any different, right? They probably saw their parents consuming. And so they're just doing what they have seen done for generations, perhaps.
We're going to take the world's most affluent generation, the most affluent generation that the world has ever seen, and then we're going to try and match that spending. Yeah, I caution my younger clients all the time, and I even talk to my baby boomer clients, and I'm like, look, here's what you saw when you were growing up, right? They were raised by traditionalists, and they saw their parents wake up, go to work, come home, never complain, barely put food on the table. And then the baby boomer generation comes in with this great work ethic and an incredible time in history and generated a really tremendous amount of wealth. And then what their kids see is their parents wake up and go to work and come home and not complain and have a whole bunch of money.
Yeah.
And that's what they think the world is supposed to give to them.
Yeah.
I had a client just a couple of months ago, in fact, tell me, Kevin, we really value all of the tax and financial insight you've given us over the years. We feel like that's really what has helped us be more financially successful. I've worked with him for about, I think, 11 years now. And he's got a 20-year-old son. And he said, Kevin, I want you to sit down and meet with my son. And that is one of those situations that you're talking about where parents really don't talk to their kids about money. They don't teach them about finance. But at least in this parent scenario, he said, Kevin, I want to pay to have him come and meet with you. And we spent an hour and a half, and it took me like 6 minutes to do his taxes, right? But we spent an hour and a half just, here are all the common pitfalls that you're going to fall into. And here's the things that you need to do to set yourself up, to succeed. But obviously, my perspective when it comes to your field is just very, very shallow. And so what I'm hoping that we get today, especially for our listeners and our viewers, is just a little more in-depth insight, something a little meatier than what I can provide. So what about like common misnomers? Common mistakes for younger investors?
Oh, there's so many, but to echo the point that you're making, it all starts with a foundation. So whenever you're young, the foundation is that you have to have some sort of spending plan, right? It's not brain or rocket science to figure out that if you spend less than what you earn, then you'll have money left over at the end of the month to be able to do something with. Most people spend more than what they earn, and so there's nothing left over to save. And so it's so much easier to accumulate wealth and to make your life easier if you always stay below what you're earning and have money set aside for a rainy day. So some of those very foundational tenets that lots of books have been written on, and that we preach from the mountaintops, is learn the fundamentals. The fundamentals is spend less than what you earn. That's number one. Save money diligently to where you can have enough money to handle a dryer going out or having to replace your microwave or car repair. Have money in those things, and then start putting money away for your future. And you can put money away for your future through various types of vehicles, but you need to be saving. And that's part of the lost art, is saving. So seek some guidance, seek some counsel. There's lots of professionals that can tell you, hey, you need to save. But if you don't have a plan and a track to run on, you're really just kind of spinning around in circles, and you're bound to make more financial mistakes than you would otherwise if you do seek some counsel.
Okay. So now switching it up, late game investing, right? So either retired, close to retirement, that kind of stuff. I have some specific questions about this. So one of the things that I find so the fundamental principles of investing at that stage, at least as I understand them, are pretty straightforward, right? There's the wealth accumulation phase of your life, and then there's the wealth protection phase of your life. And at the point at which you are no longer earning more money, the principle of your money becomes more important to protect, though you still have to hedge for things like inflation and age and when you're going to die, because if you die at 95 or you die at 80, how much money you need, it varies. But that piece being relatively straightforward. What about my clients who are aggressive investors at 70?
you don't need a lot of sexy stuff when you're a young investor, right? It's really just about saving. You could put it in something very aggressive or something more moderate. It's more about savings and the amount of money that you're saving to accumulate wealth. Whenever you get older, it's a lot different. And the reason why it's different is because new risks are introduced. There's a thing called the sequence of return rate risk for all you technical nerds out there. But basically what it says is that if the markets are dropping and you're still taking money out, you never have the opportunity to recover because you took money out. And so if you're an aggressive investor when you're 70, you have to realize that you don't have time on your side anymore to make up any big losses. And it's magnified if you're taking portfolio withdrawals. If you're taking money out of your portfolio and you're an aggressive investor, then you're going to run out of money faster than you would if you were a moderate investor. It's just the nature of it, because every 7 to 10 years or so, we're going to go through something that's going to reset the market, and you're going to lose 30%, 50% if you're an aggressive investor. And it's hard to recover from that. One thing I always talk to my clients about, or our clients at our firm, is if the market goes down by 50%, what rate of return do you need the next year to recover that money? Most people say 50%.
Yeah, they don't understand math.
Right. And so, you really got to have 100% rate of return.
Yep.
Right? If you lose 50, right? If your $100 goes down to 50, you got to earn another $50 to get you back up to 100. That's 100% rate of return on your money. And so most people, when they sit through some type of big downturn, a 30 or even a 30 to 50% return, it takes years for them to recover that. And most people can't go years without taking portfolio withdrawals. If your 70-year-old told me I had no need to take this money out, you want to be an aggressive investor, that's fine, because you theoretically have time on your side because you're not taking portfolio withdrawals.
That's realized gains or losses, right?
That's
So
right.
if you're not selling the stock, if you're not changing your position, then you haven't lost shares. You've just lost value in the shares, and if the value comes back up, you still have the same amount of shares.
That's right.
Yeah,
that's right. It's most important when you're taking portfolio withdrawals. If you're taking portfolio withdrawals, you've got to get your risk tolerance in line. And what most people don't realize is when they look at their portfolio, they see a combination of stocks or a combination of bonds or whatever it is that they see. They don't know the risk that's looming in their portfolio. Time after time again at our firm, we take someone's portfolio from the street and they're like, yeah, I'm a moderate investor, I'm a conservative investor. And you really do a portfolio x-ray or a diagnostic on it and realize that there's a lot of risk in this portfolio. They're heavily concentrated in one particular sector. And if that sector craters, they're going to lose 40, 50% of their portfolio, even if everything else is doing really well. Yeah. And so that's scary for a lot of folks. And so getting those things in balance with what's going to help give them peace of mind in life is important. Mm-hmm. And there's so many things that go into retirement planning. But I'd say one of the most important things is that whenever someone is approaching retirement or is retired, there's a quality of life that you want to have. And a lot of people that if they're invested aggressively, they can't have that quality of life because they can't have peace, because they're awake at night worrying about what's going to happen to their portfolio. In March of 2020, the stock market dropped 35%. A lot of people jumped out of the market at that point in time just to see a V-shaped recovery and all those gains to come back over the next several months. So
just locking in their losses.
And most people will say, Mike Tyson said, everyone has a plan until you get punched in the mouth. Yeah. An aggressive investor says, I'm an aggressive investor until they get punched in the mouth and lose 35% in the month. And all of a sudden they want to be a cash investor, right? Or they want to move it all to gold because the zombie apocalypse has arrived and we have no need for these stocks anymore. So it's, a lot of people think counterintuitive to how they should be thinking. The stock market is the only place that consumers go to sell things when it's lost value for some reason, right? Instead of buying things when it's on a discount and investing more money whenever it's on a discount.
Because they invest emotionally as opposed to, this is why I love facts and logic. It's why I love data. And as much objective truth as you can possibly find, because the numbers don't lie, usually.
That's right.
So let's see. There was one other thing I wanted to mention to you. That's okay. We'll skip over it. In regards to these late game investors, other than kind of getting out of the market whenever it goes down, what's one of the bigger mistakes that they make?
Say it one more time for me, Kevin.
Sure. Other than kind of what we've discussed, what is one really big mistake that late game investors make?
Well, I would replace investors with late game people, right?
Mm-hmm.
The biggest mistake is not having a plan.
Gotcha. Yeah.
If you don't have a plan, you really have nothing, right? You need to have a plan, and it's so critical in the the last couple decades of your life, because guess what? If you run out of money at age 82, you're hurting at age 83, right? That's common sense type of stuff, right? Questioning your sense here, right? If you run out of money at age 82, you're going to be hurting over the next couple years, and so it doesn't take a math wizard to figure that out. So you got to have a plan. Have a plan, stick to your plan, and things are more likely to go according to plan.
Right. But then how does Mike Tyson feel about that advice?
Mike Tyson, is considered one of the greatest heavyweights of all time, right? So, he punches you in the mouth and it hurts. But here's the thing, right? You get to go sit down after the round is over. If you can make it through the first round, you get to go sit down and come up with what you're going to do in round two.
So maybe what we're saying is that Mike Tyson probably should have had better financial professionals around him.
Well, yeah, that's true too.
So that he didn't blow all of his money, right? Because even Mike Tyson had a financial plan until he got punched in the mouth.
Oh,
right?
That's true. Yeah, I see where you're going with that.
Metaphorically.
Yeah, metaphorically. Yeah, he got punched in the mouth a few times and just couldn't get back up. But that's the difference between being rich and being wealthy. Right. So a lot of people say, well, isn't it the same thing? It's not. Being rich is having a lot of money. Right, being wealthy is having a lot of money, but having wealth or being wealthy is having sustainable wealth, and it's having the knowledge that accompanies that. That's why the lottery winner goes broke after so many years of winning the lotteries, because they have the same principles and values that they had previous to that, and they never learned about how to have wealth. They just had riches.
That's what I tell people all the time. Are you spending less than what you make? Because that will turn into wealth. You will be wealthy if you can consistently repeat that. And if you find yourself slipping out of that, then just think about the wealth that you lose. Because right now, whether you are wealthy or not, you will be, right? But if you're consistently spending less than you make.
It's funny. You could write a whole book on that, but really just sum it up on your title. Right? Spend less than what you earn. Eventually, you'll be wealthy.
It's not complicated. It's just difficult,
Yeah.
Right? Not complicated. It just takes discipline. And if there's one thing that virtually nobody has been taught in the last 20 years, it's self-discipline.
Yeah, that's very true.
Absolutely. Okay. Was there any other topics that you wanted to cover? Obviously, there's a million different things we could talk about. But we've got some questions lined up for you today from some of our listeners and viewers. But was there anything in particular you wanted to make sure that we covered?
I'd like to go to the questions. I mean, we could go off on a lot of different areas here and really, turn this show into a one-day show instead of an hour. So let's go to the questions and we'll see what kind of comes out from there.
Usually, for what it's worth, you mentioned going off on a tangent. So I stand on a soapbox pretty often. And because I'm passionate about what I do, I'm passionate about helping people and trying to get people to make better decisions than they make, whether in regards to taxes or wealth management. Many people don't know this, but I had a Security 7 license years ago. It's now since lapsed. I really didn't enjoy doing what you do, but I'm still passionate about making sure that people make good decisions for themselves and for their future.
Well, I think to one thing that I will, I guess, jump in here and talk about is their advisors are cut from different cloths, right? So a lot of the advisors, you say you're in an aging industry, the financial services industry, including the wealth management or the retirement planning space, is also in an aging industry. They've done things the way that they've always done them. There's no new ideas coming in. There's no new strategies to mitigate taxes or to plan differently than what they've done before.
Right.
And so there's not really a whole lot of, the average age of a financial advisor right now is 58. So most of them are spending, most of their time on the golf course, wrapping up their life. And maybe that's what they deserve because they've worked hard. As you alluded to, that baby boomer generation, they worked hard.
Yep.
So they do deserve to do that. But is that the advisor that you deserve? Or do you deserve someone that's going to be working around the clock to help you make good financial decisions? And the difference between most financial advisors is that some are just solely focused on one particular area. Maybe that is just on investment management. But the long and the short of it is that wealth is not created by earning an extra 0.5% rate of return on your investments. It's the behaviors, and it's a summation of your habits and behaviors that ultimately drive wealth. And sometimes you may not have that internal discipline, and you need someone else to help you to have that discipline. And that's what you do for your clients, and that's what we do at Centric.
Yeah, so we take an education approach, right? Education focused approach of just trying, because generally speaking, I can't make decisions for you. I'm not walking a single mile in your shoes. And so my job is to give you all of the right information and try to really go after that emotional button, right? You push that emotional button enough and people will start to listen. Some of my clients are more fact-based, which I find those conversations very easy because if I can talk to you in facts and logic, give me 10 minutes tops and I will help you see the light based on statistics and numbers and math. But most people I find don't respond as much to the facts and the logic side of education, but more the emotional appeal. Okay, so we'll go ahead and wrap up this section and jump into the comfort zone. So Clark, I know you've been able to gather quite a few questions for us. So why don't we dive in? What do you got for us today?
Yeah, so we have a few questions, like you said. The first one is, what is better, Roth or traditional?
So the first thing I will say, because this is not the first time we've heard this question, is we have an entire episode based on the tax applications between Roth and traditional. So go and listen to that episode if you have this question. That being said, I would love to hear, Zac, your perspective on this.
I imagine without listening to that episode, it's probably going to jive with your thoughts around that. So there's a lot of thoughts going on in my head, but first let me say, I don't think that there's a right and wrong.
Yeah.
So this is not good versus evil. There's a reason for both of them. And there's certain times and seasons of your life that perhaps it makes more sense to invest in one versus investing in the other. It also depends on the current tax regime and everything else that's going on. So not good or evil. Some people will say traditional IRAs or traditional 401k investing is evil or that it's good. It's neither here nor there. It's the same thing with products in the financial services space. I don't think any of them are evil or bad for people. I think it's how they're applied and how they're used that would create if it's going to be a good outcome or a bad outcome for that individual. With that said, I'm a very large proponent of the Roth. I think the Roth is significantly underutilized in our society. It's one of the greatest gifts that the tax code has given to us because you can put money into it, and when you retire, you can take money out of it tax-free. It doesn't matter what the tax regime is at that point in time. We could have 50% average tax rates at that point in time, but you're taking money out at a 0% tax bracket. So it's a wonderful gift, and we need to utilize it more.
Now let me hit you with something here, and it's going to seem a little funny how I'm leading up to this, but I promise I have a point. 2020 ended with some tax law changes. The CARES Act was pretty significant in regards to the kind of COVID, the answer to COVID for income tax purposes. It shook up a lot of things in regards to retirement distributions and all kinds of stuff. 2020 ended, and on March the 11th of 2021, the American Rescue Plan was passed. It included 2 retroactive changes back to 2020, which is insane. 55 million people had filed tax returns by the time this was passed. And now the IRS, who is 8 months behind on opening mail because their staff was working from home all year, is now being tasked to recalculate tax returns. And they notified taxpayers, now most people didn't hear this part, but we pay attention to what the IRS says. They notified everyone that while they're going to recalculate these tax returns, and please don't file an amendment, if the recalculation of this return were to result in you receiving an additional credit, we're not going to calculate that. Wow, okay, so it's my right as a taxpayer to represent myself in telling the IRS what my tax liability is based on the law. And what the IRS is saying, but don't file an amendment, don't represent yourself, we will calculate it and will tell you what you should receive. you can tell how I feel about that, right? Very, very frustrating. Where that relates to this topic is my only concern with Roth, and to be clear, a large majority of my investing is in Roth accounts. I feel the same way that you do. But the number one risk, in my opinion, with the Roth investing is legislative risk. So what is your answer, or do you have one, to the potential for legislative risk for in the future? Specifically, what I'm talking about is I don't think that this is going to be hey, by the way, we're just going to tax Roth distributions now. I don't think that we're going there, but I would not put it past Congress to come in and say, we're going to put a 3% excise tax on Roth distributions or something like that.
Yeah, you never really know, but I if you had a board back here, I would start writing in cursive. The handwriting is on the wall.
Yeah.
I mean, it's been on the wall.
Please don't write on our wall.
Yeah, I won't. But the handwriting is on the wall. The changes are coming. Changes have happened. Who knows what will happen to Roths in the future? I'd like to think that anyone that had money in there would be grandfathered in. Something new would be created, or they would end Roth contributions. Who knows?
Or there would be riots, right? I mean, that's a lot of post-tax money.
It affects a lot of people, but I mean, what do you you don't really have any other option, really. I mean, even a 3% excise tax is better than the 30 or 40 or 50 or 60% income tax bracket that you're going to be in whenever you start taking distributions out. So it's still a better alternative. Most of my money is in tax-free buckets as well, including the Roth. So I'm a big proponent of that.
Roth? Yeah. It's tax-free, but in the Roth post-tax? Are you talking tax deferred? Or are you talking about tax-free?
No, I'm talking about their different tax-free buckets that our money is in.
So this was bound to happen. And in fact, I'm surprised it didn't happen until now. But there's a jargon difference between taxation and financial, right? And so you and I are actually, I'm on the same page as you. Yeah, I just don't use the word tax-free, but I understand where you're
Roth IRA, tax-deferred, and then tax-free on the distribution side. So I like to have as much certainty in my overall financial plan and retirement plan as I can. And that is trying to eliminate the uncertainty of what our tax environment is going to look like in the future. But here's the deal, right? I said the handwriting's on the wall. There are white papers out there right now by leading economists that suggest all the trillions of dollars that is in IRA and 401k money is not your money, it's the government's money. Leading economists have published white papers saying this. The United States will not be the first country that seizes the wealth from its citizens. So there's already white papers out there that say, your money in your IRA is our money.
Or are you talking about seizure of money?
I'm talking about seizure of money.
Wow.
So there's already white papers out there from the leading economists in the country that say it is the government's right to have this money. And the government looks at it as it's their right to have the money. And if you have money in an IRA, you have a partner in your IRA. And it's a partner that you probably don't want. And it's a partner, I have a partnership. Centric is a partnership. Mm-hmm. I know the amount of equity that I own. I know the amount of equity that my partner Oscar owns. In your IRA, you do not know what that partnership percentage is, right? In a Roth, you do for now. Who knows if that'll change? But you know for now that you're 100% owner in that Roth IRA because you've already paid your tax bill before you put money into it. In a traditional IRA or a traditional 401k, you do not. Mm-hmm. Your partner is the United States government, and it is their partnership share is at whatever percentage they declare at some point in the future whenever you start taking withdrawals. And that's a scary thought.
So let me hit you with one more thing, and this is just a math-based kind of viewpoint here. The concept of principal investing power matters. How much you invest makes a difference. The more you invest, the more grows. You invest 100,000, I invest 10,000. We both earn 10%. The rich get richer, right? Okay. And I'm not saying that for your benefit. Obviously, you know this better than I. I'm just making sure that we're all on the same page. Money is a finite resource. How much I can contribute to a Roth IRA, meaning I have to pay the taxes first, and how much I can contribute to a traditional IRA. Theoretically, the amount I can contribute to a traditional IRA is higher because I save more upfront dollars. Do you think that comes into play in making any of these types of decisions?
I think a lot of people take that into play, but I think that they overweight that consideration.
See, that's why I'm asking you. Yeah, because I want to know your opinion.
I think they overweight that consideration. Again, there's power and certainty on knowing what your tax rate is going to be on distribution. There's a lot of certainty around that is completely underweighted. not to mention the fact that your $100,000 in your example that you put into your IRA, you're foregoing paying tax on it now to pay tax when it's grown considerably at whatever the rates are at then. So you're going to be paying taxes on a higher balance at whatever the rates are at that point in time. I would rather pay taxes now, and in my opinion, what a favorable tax rate is according to the tax code that we've seen throughout our country, throughout the history of our country.
We have the lowest tax rates we've had in a really tremendously long time. Yeah.
That's right. Perhaps the lowest that we've ever seen and that we'll ever see. So that's why I'm a big proponent of a Roth. I think it should be refreshing that an advisor that you go to, a wealth advisor, an investment advisor that you go to, is willing to say put money into a Roth, because as an advisor, to your point, you can put $100,000 into an IRA, but maybe you can only put $60,000 into a Roth. Well, if I'm an advisor, I want to have a larger balance so I can make more money. But I'm sitting here telling you, you got to put it in a Roth because it's going to be more beneficial for you long term. So that's my 2 cents.
Fantastic. Well, I think we answered that and then some, but that's a topic that I enjoy talking about. So what else you got for us, Doc?
Next question. Should I contribute to a 401k or a brokerage account?
Okay. So let's set the premise here, because this isn't included in the question. But whether it is a traditional 401k or a Roth 401k, my 401k is a Roth 401k, right? So I invest post-tax. But either of those, right, or a brokerage account. So obviously from a tax perspective, I have thoughts on that. But from an investing perspective, what are the merits, one way or the other?
Well, I mean, whether it's traditional 401k or Roth 401k, you get tax deferral. So you have the tax deferral, assuming you're going to use it for retirement. Now there's all types of flexibility with loan privileges and other laws that were passed that allow you to take more money out than you were ever allowed to take out before, which is great from a flexibility standpoint, but it's really to the detriment because, again, as you mentioned to before, we lack discipline typically. And so whenever we see this pile of money out there that's supposed to be a nest egg to secure our financial future, we utilize that $100,000 in our 401k to put a pool in the backyard.
Yep. Well, what got worse with the CARES Act distributions is what the regulations were initially and what they ended up being were actually slightly different. And they tightened up those restrictions. And so you had people taking out $100,000 who didn't qualify. Awful. Yeah. Sorry.
I am a proponent of brokerage accounts as well. There's a lot of benefits to having a regular brokerage account, one that is we call it a taxable brokerage account, because if you sell anything in it or you collect dividends and there's some type of tax that you're going to pay on that on a regular basis, there's, according to current law now, which is under consideration to be changed, there's step up in basis whenever you leave appreciated stock to your kids or to the church or whoever you leave it to. So there's a lot of considerations for that. And having it in a brokerage account also creates flexibility as well, because if you have it in a brokerage account, then you can access it perhaps more easily than you can if it's in a traditional IRA or a traditional 401k or a Roth or something of those sorts. Again, you have to pay a tax bill if you sell appreciated stock, but you have a little bit more access to it.
So obviously there's a cap that you can contribute to a 401k.
Right.
And I would assume that your advice, if you are meeting the cap and have other investable monies, is looking at a taxable, brokerage account or something like that. Oh, I would assume, but
can I jump in? Yeah. So there, and this goes back to the lack of creativity that we've had in our advisor community for so long. So that's what our parents did. Right? That's what our grandparents did.
Punch me in the mouth. Tell me why I'm wrong.
That's most of the wealth that I've been able to accumulate that is non-business equity has been in vehicles that are either Roth IRA or something outside of a brokerage account, because there are other vehicles that are out there that still allow you to have tax deferral. There still are other vehicles out there that allow you to get tax-free income outside of a Roth whenever you take distributions from it. Most people don't know about it. Most advisors aren't talking about it, because at the end of the day, if I'm 58 years old playing golf 3 or 4 days a week, what do I want to learn any new tricks for, right? I'm about to sell my practice for a couple $1 million whenever, the next couple of years, and I don't have to worry about it. I don't have to learn anything new. My clients have $500,000 or whatever to invest at that point in time. I'm collecting my fees and I got some staff answering calls. I'm good.
Ooh, you are putting them on notice.
Well, they need to be on
Yeah.
notice, but
I think that's fair.
the winds are shifting,
Yeah.
and you're gonna. I like being a young advisor, also born in the 80s, because there's a tremendous amount of opportunity for younger advisors, and in our firm in particular, to be the benefactor of a lot of these people retiring and us introducing strategies that they have not seen before.
Okay, great. Did we cover that one?
Yes.
Okay.
I think that leads me very well into the next question. What makes for a good financial advisor?
Wow, that is a really good question. Do you have your thoughts on it?
Oh, absolutely. Yeah. So let's provide a little bit of detail here. As a firm, Molen and Associates has worked with several financial advisors. There are not, how do I say this correctly? Well, I'll repeat what you said, right? Not every financial advisor is cut from the same cloth, right? I have a value system, just like everybody does. And so not every advisor I really jive with. And I've worked with some advisors who I've not really enjoyed working with. And so, for me, it's transparency, honesty. You have to be looking out for my best benefit. Because if you are looking out for my best benefit, it is relatively apparent, like you mentioned, traditional, more money, your commission is higher. Roth, less money, your commission is lower. But if you as the advisor are recommending the Roth, that really should key you into the fact that they're worried about you, if that's what they believe, right, that the Roth is better for you, that should key you into the integrity of the advisor to some small degree. That matters a tremendous amount to me. As a firm, Molen Associates has 4 core values. So services the client above all else, does the right thing, questions to solve, and shows unequivocal excellence. So those are our core values. It helps that I was one of 3 people who wrote those values. And those really are inherent in me. And my folks started the company 40 years ago. And I was raised by people who had those values, who currently own the business. So you can imagine that my mother, my father, and I share a lot of values. And so really the type of financial advisor that I'm looking for is not someone who is looking to let's just say the transactional advisor. Even if that transaction nets me a tremendous amount and nets them a tremendous amount, and then they want to move on to the next person. Some people will enjoy that type of experience, even if it is to my best benefit right then and there. I really need someone who I want to, or I really want an advisor who I want to grow with.
Sure.
I respect those types of advisors more. And so it's no shock to you, having heard that, why I enjoy working with Centric and with you and Oscar and your team.
Yeah. So it's a very small pool that qualifies for what you said. I think less than 5% of advisors in advisory firms operate in that capacity that you said. Transparency. Really, what it comes down is to the standard of suitability versus the standard of being a fiduciary.
Yeah.
At Centric, we're licensed fiduciaries, meaning that we have to act in the client's best interest always at every time. Every recommendation, every strategy, every thought needs to be in the client's best interest. Only 5% of advisors, shockingly, operate in that capacity, right? Something as emotional as money and important as money is, only 5% of the people are going to look out for your best interests that are out there. The other 95%, they're not bad people. They're just operating in a different capacity. And as long as they can prove that what they're putting in front of you is suitable, could net you a great profit, like you said, but if I can prove that it's suitable to you in that suitability standard model, which 95% of advisors operate in, then they're okay to push that to you. And you have no legal recourse against them because it was good for you. May not have been what was great for you. May not have been what was best for you, but it was good for you. And that's a big difference.
Good, better, best. Yeah.
Good, better, best. So that's one of the fundamental differences between when you're looking for an advisor, what you should look for someone that is a fiduciary. Look for someone that's a certified financial planner. If you're looking for a wealth advisor, those are 2 very important things. And then the other thing is creativity. Albert Einstein said that creativity is more important than knowledge, right? Fortunately, at our firm, we have both, right? And I know you guys do too as well at Molen and Associates. You have creativity and you have knowledge. That's a pretty dangerous combination there, right? That's a good 1-2 punch. So you need someone with knowledge, right? So we have knowledge. We have multiple certified financial planners at our firm. We have chartered financial analysts. We got a chartered divorce financial analyst on our team. So we have a lot of the industry credentials. We have the industry knowledge, but we also have the creativity. Because if you've always done things the way that they've always been done, you're not going to get any type of different results. And so there's new product evolutions, there's new strategies that have come out. The market has changed drastically over the last 10 years or 30 years. And so new things have to come about. And you want to work with a firm that has a finger on the pulse of those new cutting edge strategies and opportunities if you want to be a benefactor of those things.
Yeah, shameless plug here. You want to talk about knowledge. I had the unique pleasure on a couple of instances to stand across from Richard Cole with Centric. Wow. So just introduce Richard to us for a second.
Yeah, Richard he's our chief investment officer, and really, we call him our investment wizard because what he does all day long is study the market, study the economy, manage investment portfolios. He's a chartered financial analyst. That's the highest designation that one can obtain in the investment management industry. It's a master's degree in investment management for all intents and purposes. Super sharp, super smart, one of the brightest guys that walks into the room anytime that you're talking about his subject matter, right? Is he a financial planning expert? No. But is he an investment expert? Absolutely.
Yeah. So first, let me tell you that I am being completely 100% honest with you when I tell you this isn't prepackaged, right? We didn't talk about the fact that I was going to mention Richard. I just have had the unique pleasure of talking with him on a couple of occasions. And I don't call a lot of people highly intelligent because for a lot of people, it's just talking. But wow, 5 minutes of talking with him and it's just 70% of what he says goes over my head. Now, it hurts me that I don't work in your industry, right? And he talks at such a high level, but I am consistently impressed every time I speak with him. So,
well, the industry and most advisors are salespeople by nature, and you get a bunch of salespeople in the room, and they want to be the biggest, baddest, brightest peacock of the bunch, and so they're the smartest guys in the room. The funniest thing is that when Richard's in that room, they all shut up because they know that if they're going to say something that's out of the ordinary or wrong about the economy or the markets or whatever the case may be, there's someone in the room that can call their BS.
Nice.
And so it's always fun when you gather a bunch of those guys and Richard's in that room because all of a sudden they don't talk quite as much as they did before.
That's great. So like I said, shameless plug. Did we cover that question, Clark?
Yes, thank you.
Okay, good.
I think we got time for two more quick ones. Next question, how do I avoid taxes on highly appreciated stock?
Oh, I thought you said it was a quick one. So obviously for taxation purposes, I certainly have some thoughts. Do you want to lead out or do you want me to?
Yeah, I'll take it. So number one, we're getting into the secret sauce here, guys. So I mean, free. Don't
give it away for free.
Right. If you're good at something, never give it away for free. Is what they say. But at the same time, we're here to educate. So I'll give you a couple.
Wait, was that a Joker reference?
Maybe.
If you're good at something, never do it for free.
Great movie, by the way.
Absolutely.
Yeah, so, there's a couple of things that you can do. Number one, the most obvious is, hey, don't sell your appreciated stock. Again, you don't have to be a wizard to figure that out. But a lot of people maybe need to sell that stock for diversification reasons or for income purposes or whatever the case may be. If that's the case, do some tax loss harvesting, right? And work with us and with you to figure that out. What stocks have not done as well that we can sell and offset some of those gains on the highly appreciated stuff to offset with some of the losses, right? So there's an opportunity there. There's opportunities to write some options on that highly appreciated stock if you're wanting income from it without having to sell and generate that taxable occurrence. So there's those things. If you don't need the money or you don't plan on using that money and you plan on leaving it to your children, you don't do anything with it. It'll, according to current tax regime, which as you know, they're trying to change this already and they will successfully change this. But under current tax law, whenever you die, you get a step up in basis. And so your kid or whomever inherits that stock at that newly appreciated price and no one's paid any taxes on it. The richest people in this country have been doing that for years. You think Bill Gates and all those other guys sell all their stock? No, what they do is they collateralize their stock, take loans out against it and use the loan money for whatever needs and purposes that they have. They're not selling appreciated stock. They're trying to get that step up in basis, baby. But it's going away. Yeah. So you're going to have to figure something else out. And then there's other creative things you can do like charitable remainder trusts, where you donate money to a charitable remainder trust, and you can use the income for your own purposes, right? You can get a tax deduction with that. There's some creative things you can do there, but you don't have to recognize that gain in that stock.
Yeah, one of my favorite things is if I have somebody that is consistently making charitable contributions to a sophisticated charitable organization, donate the appreciated shares to charity, and rather than paying $50,000 of tithes, donate $50,000 worth of the stock. You get the write-off, they get the value, nobody pays the taxes.
That's a really good point that you bring up, and slightly off topic from the appreciated stock, but I think a very good compliment is required minimum distributions.
Yep.
So many people, everyone has to pay required minimum distributions. For those that are listening, that are thinking, well, I can accumulate all this money in my IRA. I don't care if taxes are 80% of the future. I'm not going to pay it.
Yeah.
No, the government's too smart for that, right?
Mm-hmm.
They're going to make you take
piece.
money out in the form of required minimum distributions. So they're going to make you take money out. That's in your early 70s. So they make you take money out, and it's a proportion of your account, and it grows as you get older.
Mm-hmm.
Essentially, they're trying to force you to take all the money out before you die, so that they can collect their tax revenue on it. Makes sense from a government standpoint. But those that are charitably inclined, they can also donate as their RMD to a charity, not recognize that and have to pay taxes on it, and give that money and satisfy their RMD while giving money to their favorite church or charity.
Yeah, so that was actually part of the Secures Act, which was passed in 2019. Late 2018, early 2019. It was applicable starting in January 2019 at least. So that's relatively new. Those QCDs, right? The qualified charitable distributions. Those are fantastic. Unfortunately, I don't have too many people who are at the stage of their life where they want to be making significant charitable contributions and are taking required minimum distributions. It's also relatively new, and so some people just don't know about it. I love introducing that to them.
Well, and I think the point is that's why you have to have a professional on your team, right?
Right.
You got to formulate your team of professionals that you surround yourself with, because this law is always changing. New opportunities always exist. Whether you're taking advantage of that part of the tax code right now is really irrelevant, because you want someone to introduce you to it and know your situation enough that says, hey, this is going to be a good idea for you.
Yep.
And you don't have to recognize that $25,000 of income this year because you're already given $30,000 to the church. Let's do a little switcheroo here and take care of that. But you have someone always looking out for your best interest and looking out for your future interests as well. Because some people neglect their 85-year-old self to take advantage of their 72-year-old self.
Mm-hmm.
And you need someone looking out for both those people. And your 85-year-old self will thank the 72-year-old self whenever you get there.
Yeah, that's right. So actually, are you familiar with Jordan Peterson at all? Okay, clinical psychologist. I've enjoyed some of his work. One of the things that he taught, and I don't think it was in his book 12 Rules for Life, but I think that it was in one of the podcasts that he was doing. He talked about how you are you, but you are also a community of you, right? There's the past you, the present you, and the future you. And stealing from the future you, right, it does damage to you. And so there's this whole psychological kind of aspect of the community of you. I love that. And I do this all the time. So just as by way of illustrating the point, Kevin last year made notes in my tax software that assisted me this year, right? And so I pat myself on the back every time I high five my past Kevin. Thank you so much. Yeah. Because it's stuff like determining the basis on something. Well, we already determined the basis on it then, and I don't have to redo this again because it takes a lot of time, right? Mm-hmm. And absolutely, I'm doing it for my client's benefit, but I'm also doing it for me, right? Mm-hmm. So this theory of not damaging your future self or helping your future self, absolutely.
Yeah, and an easy way to think of that, I mean, you can translate that very well to sports, right? If you get fouled and you got to go shoot 2 free throws, right? You're going to be wishing that your future self practiced more free throws throughout your practice time, so you can knock those free throws down. And if you knock them down, right, are you expecting everyone to say that it was luck that you knocked those 2 free throws down to win the game? No, it's all the discipline and the hard work that you put in before, the notes that you took, whatever the case may be. Yeah. But you're high-fiving the past efforts that you put in, and it's no different. It's probably a little easier to think about it. You know, your past efforts that you put in. It's harder to think about stealing from yourself in the future. But that is what you're doing. If you don't go to practice and you go show up to shoot those 2 free throws and you miss them, right? By not practicing, you damaged your future self. You damaged your opportunity to win that game.
Are you a basketball aficionado at all?
I love basketball. Yeah, I played high school, college, so don't play as much anymore. But for until COVID, I was always in a league. So
Gotcha. So you might understand if I just say, we're just talking about practice.
yeah,
Do you understand what I said?
Yeah.
I understand. Thank
practice.
you. Yeah, it's practice, man. We're just talking about practice. Love that.
Another guy who ran out of money. He was rich, not wealthy.
I didn't know that.
Yeah, but
Wow.
he does have a deal with Reebok that's going to give him a ton of money at some certain age. So he'll get one last windfall. I think it's like $30 million. He ran out of all his other money, but he's going to get one
Doesn't
last
surprise
payday.
me. Doesn't surprise
one
me.
last payday.
All right. Did we cover that one?
Yes. Last question for today. With the changes in the White House, how do you think these changes will affect the market?
Ooh,
That's a big one.
yeah, that's a really big one. Wow. Changes in the White House, how they're going to affect the market. Let me start off by saying I'm a believer in the United States. I'm a believer in the economy in general. Companies are creative. They find a way to make money in every type of economy, every type of political regime that's occupying the Senate or the White House. So they'll find a way. Does that create some turbulent times in the process? Sure, it can certainly do that. But will the American economy be okay? Yeah, I think it will, because companies are not dumb. They're going to find a way to still produce a widget and sell it to you, or to give you a service, or allow you to keep doing your Google searches or whatever. So they'll be fine. I think that there could be some added volatility that comes about. I also think that even with some of those changes, because we have a lot of tailwinds behind us, because all the COVID restrictions are being lifted,
Yep.
that it may kind of buoy that situation
It's
a little
the
bit.
easiest economic recovery that has ever happened. Just end the lockdowns and the
That's
economy
right. And we go back to normal.
becomes very healthy. Yeah.
That's right.
Obviously safely and that kind of stuff. I'm not I'm not what you would call a COVID denier or anything like that, right? I wore a mask to the gym. I'm vaccinated, right? I've had both of my shots. And so wearing a mask kind of bugs me if I'm vaccinated, but I wore a mask to the gym and to get to my locker, but once I start running, I'm taking that thing off. I'm not running with a mask on. That's crazy.
Yeah. There's I don't see so kids in junior high that are playing junior high basketball, they're masked up while they play.
Really?
Yeah, and I mean part
Oh
of
my
being a top
haven't seen
tier
that.
athlete is getting oxygen
Right.
through your blood.
Yeah.
I mean, could you imagine running a marathon or something with a mask on? I mean,
No.
you're gonna pass out at mile 1.
Goodness gracious. So let's see. I don't think I have any insights into that one at all. So I think that wraps us up here. Well, Zac, thanks so much. Really enjoyed having you on. Was there any final thoughts you wanted to share with us?
I would say the final thoughts. I mean, there's so much that goes into financial planning and planning your future and everything else. The main thing is seek guidance early, and seek guidance with a competent professional and one that has your best interest. If you do those things, they can help steer you in the right direction. Yeah, you may have made some wrong choices or some bad financial moves in the past. Who hasn't, right? That everyone has, but it's not too late to get started. It's not too late to right some of those wrongs and get on the right track.
Yeah. Question your own sense. Look for professional sense and earn more sense. Is that too cheesy? I think that's a little too cheesy.
I
That's
like
all
it.
right. We'll,
I like it.
We'll call it there. Thanks so much for joining us. Hope you enjoyed our special guest here with Zac Majors with Centric Advisors. We are really excited to bring you more guests and more content, but expect to see Charlie very often just as well. Thanks so much for listening, and we hope you join us next time.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molentax.com.